Yesterday we had the Q3 GDP figures for New Zealand and they revealed that the economy grew 0.2% over the quarter. So that was about halfway between what we expect and what the general market expected. So the grand scheme of things not too different from expectations. We also saw Q2 get revised up to 0.2% from 0.1%. So I guess you could say we doubled the growth rate in Q2. So what we've seen out of those figures is essentially the economy has started to really stabilise through that middle part of the year. At the moment, a lot of what's driving the economy is still the housing market. It's the housing related expenditure, the services related to all the housing turnover that we've seen that's driving the economy, that and a bit of oil exploration. So it's still pretty patchy. Going forward, what we'd expect to see over 2010 is that we'll see construction start to pick up a little bit more noticeably, manufacturing will start to recover, and we should start to see in general the export sector do pretty well. For the Q3, a bit of a mixed bag for the agricultural sector. We saw meat exports fall quite noticeably, down about 12%, and that really reflects the fact that we have got the drought and it has affected our ability to supply meat. On the other hand, dairy export volumes lifted about 4%, so that sector's doing fairly well. When we look over 2010, we just expect the economy will continue to gradually gain momentum, that recovery will become more widespread, and as the global economy continues to recover, that should help our overall export sector, including agricultural returns. One key trend we're likely to see over 2010 is that interest rates continue to grind up. A lot of what we've seen in 2009 has been the longer term rates lifting. Increasingly we'll see those shorter term rates start to lift up. So right here, right now, there are still opportunities to benefit from the very short-term rates, but those opportunities will start to disappear. We have already, as we go into the end of the year, started to see long-term rates lift, particularly in the US, and that's likely to put a little bit of pressure, I think, on New Zealand borrowing rates. The key theme is, for next year, the Reserve Bank is going to, at some point, lift those rates. At the moment, they're saying around about the middle parts of 2010. We suspect it might be a little bit earlier, but that's just another trend to be aware of. A lot of those opportunities to fix debt at relatively low rates are continuing to evaporate. What we expect is we'll see a lot of our customers starting to fix for very short-term rates or remain on floating for a lot of 2010. One interesting trend for our exporters is what's been happening with the New Zealand dollar. We have actually started to see that soften a little bit as we head into the end of the year. Part of that is really about the US dollar seeming to find its feet. Often this year what we've seen is when good data's come out in the US dollar actually weakened, but over the last month we've actually seen as good data's come out in the US dollar has actually strengthened, which is what really seems to make sense when you get out of those rather abnormal times when risk aversion and risk appetites have been changing. So as we head into 2010, one of the questions is going to be, has the US dollar already found its base? So has the New Zealand dollar already peaked? Well, one thing I think we have to be aware of is the interest rate differentials. We do think that once the Federal Reserve starts to lift interest rates, that should put a bit of a floor under the US dollar, and we may see some of its weakness start to reverse. But there's always the possibility that our own central banks could be lifting rates earlier than what we see in the US, so there could still be a period where we see our dollar start to lift up. But certainly a key question to be asked in early 2010 is whether or not the US dollar has actually found a base, and if so, it may mean that the New Zealand economy gets less of a hammering from that high Kiwi dollar.